You tweeted about Fed policy earlier in the week. You said, quote, "I would not be surprised to see a significant policy pivot in the next 3 to 6 months." What did you make of Powell's speech yesterday? And tell us what that pivot might look like in the coming 3 to 6 months.
Hey guys, welcome back to Library of Wealth. Today we have the CEO of Ark Invest, Cathie Wood, with her strategy for success in an inflationary market, as well as what she sees coming for the next few months. Cathie observes that volatility has become the watchword in the industry, as most people now associate it with risk and uncertainty. When time horizons collapse, volatility increases. Wood has begun using volatility to her advantage, focusing all of her concentration on the highest conviction names. Wood stresses the importance of keeping a 5-year investment time horizon because in that time frame, there's an enormous difference between linear and exponential growth. She believes that Wright's law is the right answer in terms of exponential growth trajectories, and that the surprises along the way will be huge. Cathie sees that in the next 5 years, the market will be tough, but it's certain that the exponential growth trajectories have been accelerated by the turmoil in the labor market's logistics. Let's listen to Cathie Wood as she gives her opinion on today's market conditions and what's to come. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
Yes, well, he repeated what he said in Jackson Hole, essentially. They're focused only on prices. Now, they have a dual mandate, employment and prices. Frankly, I'm happier that they're focused on more of a price rule, so that's good. But I think the reason for the pivot is going to be a massive amount of deflation in the system. It's already here. If you look at commodity prices, the gold price, for example, it actually peaked in August of 2020, and it's at the lower end of a 2-year range, while copper has broken down, oil is breaking down, lumber has crashed, iron ore as well. Freight rates out there are suggesting that the supply chains are loosening up quite significantly. The rates are coming down. So we've got deflation in the system. And the way I describe what's going on right now, I was in my early days in my career in the early 80s when Volcker was taking a sledgehammer to inflation because it was embedded in the system after 15 years of profligate spending, Vietnam War, Great Society, and then going off the gold exchange standard. A sledgehammer, that's what he needed. That is what I believe Chairman Powell thinks he needs. And we just don't think that's true because we see so much deflation. And then one more thing. We also see a massive inventory overhang around the world. You've got Europe in recession, China in recession, effectively. And here in the United States, retailers are bulging with inventories, which will have to be cleared with discounts. So we think we're going to see some major downside surprises in inflation during the next 3 to 6 months.
Wood expands on Raoul Powell's take on the rapid evolution of innovation. But Cathie has also seen that in the public equity markets, it's been completely devastated in the past year as well. She also notes that last year, people thought that the economy and interest rates would go up, and even though inflation would rise, it would eventually be tamed. Instead, the supply chain issues didn't go away, and the fear of inflation and interest rates that had at first only begun to affect the market as a whole. Wood has noticed the 2-year Treasury and market is priced in at least 4 interest rate hikes.
First off, on inflation, will the Fed be able to reach that target of 2%? And when do you expect the Fed to see inflation at these targets?
So the Fed is looking at the PCE deflator, which peaked in February at 5.3%. It's down to 4.6%. And we believe we've already seen some negative numbers. Nobody believes them. We do. And we believe we're going to see some more negative numbers during the next 3 to 6 months. So wouldn't be surprised to see it well down into the 3s in the next 3 to 6 months, if not into that 2 handle. And I think if we get enough sequential declines, that the Fed will change its tune quite dramatically.
Wow, that is a big deal. You're talking about 2% inflation within 3 to 6 months over in the coming year?
Well, I think that the Fed will be looking at the sequential numbers, many of which will be negative, and that will encourage them. Even if we don't have that 2 handle, we're in the 3s and we're coming down quickly, I think they'll change their tune. And perhaps they will take interest rates up 75 basis points this time, but the next time 25 to 50 basis points, and then following that, we shall see.
And this expectation that we would see a pivot, that the Fed would blink, essentially sparked that pretty good rally in the month of July. But what is it going to mean for the macro story, Cathie, and your view on profits? Because we've got the second read of the second quarter GDP coming, showing a contraction of 0.6%. This after a 1.6% contraction in the first quarter. Tell me what you're expecting in terms of the profit impact here and the impact of the Fed slamming on the brakes, pivoting here, and impacting the macro story.
Sure. Well, we think profits are going to be under tremendous pressure. And until some of these cost declines make it through and inventories are cleared. Now, we do not think this will be anything like 08, 09, which I know many people fear. We think it's much more of an inventory recession and a drag from the rest of the world, Europe being crushed by energy prices, China being or readjusting to quote unquote common prosperity. So I think it'll be more of an inventory recession. And, there's been a lot of denial that we are in recession. We think we are. We think it's an inventory recession and that we'll be coming out next year, whereas many people, forecasters are saying we'll be going in next year. So I actually think the market will be looking up as we're exiting this year.
Do you worry that Larry Summers will ultimately be right? The other day, he said, look, all of this focus on slamming on the brakes is going to mean unemployment at 6.5% at some point.
Yes. Well, we do think there's been some labor hoarding in here. The employment numbers have looked strong. If you peel the onion a bit, the underbelly of employment is not strong. With household employment essentially flat over the last 4 to 5 months, which includes a lot of small businesses. That's where we see a lot of the pain right now. But the labor hoarding is because companies couldn't get labor during the supply shock and the COVID. And so now that they can, they're holding on a little longer than I think they would normally. I'd be surprised if we go all the way to 6%. I do think the inventory recession will be somewhat sharp and will take the unemployment rate up. But I'd be surprised to see us get all the way to 6%.
Cathie believes in the research showing how profound changes are, how immense exponential growth will be, and how the equity market cap will explode in these areas. Wood continues by saying the move to risk off for most traditional asset managers means getting back to their benchmarks. And when looking at all broad-based benchmarks, there is no true innovation, and what innovation is being seen is mostly captured in mega-cap tech stocks. This has become a very disproportionate weight in numerous indices. The style of benchmark investing in traditional asset management has been supercharged during the past 20 years by first tech and telecom, then by the 08-09 meltdown. Wood says that research is becoming very benchmark sensitive, and portfolio managers and analysts are becoming short-term in their time horizons. The coverage in the traditional asset management world is very specialized, as it is broken down by industry, sector, and subsector, which, because of siloization, their ability to understand the convergences between the 14 technologies is inferior to Wood's team. What do you guys think about Cathie Wood's opinion on the style of benchmark investing that is now common in traditional asset management today? Let us know in the comments below. Guys, thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.